So today we'll start with IND AS 2 inventories. Okay. So what do you mean by inventories? Okay. Inventories are assets. Okay. Inventories are assets for the business. Okay. So what is inventory? Okay. They are held for a period less than 1 year. Okay. Let's suppose you have a business of let's suppose hosiery. Okay. So the items which you are selling, the hosiery items, it is your inventory. Okay. So what are inventories? These are held for sale in the ordinary course of business. Okay. If I take a vada pav stall, okay, your vada pav is your inventory. Okay. So your vada pav is your inventory, and what is your you have vada pav. Okay. So vada pav is your inventory, and the kadai, okay, the kadai is your fixed asset. Okay. So now we are going to learn about the inventories valuation. Okay. So how do you value the vada pav? Okay. When you are recording in the books. So the first one is these are held for sale in ordinary course of business. Okay. Means what? What is ordinary course of business? It is for your regular business and not for special business. Okay. Ordinary course means you only sell, let's suppose you are selling fixed asset. Okay. Your kadai you are selling. You don't sell it every day. Okay. Once it is once it is used indefinitely, you will sell it in scrap. Okay. So that's not your ordinary course. Your ordinary course of business means what? Which you do in your day-to-day life. Okay. So it is held for sale in ordinary course of business. So it is your finished goods. Your vada pav is your finished goods. Okay. So next we have is production in process. Okay. So what do you mean by production process? Which means what? Your the one which is in production. Okay. Your vada is not for sale. Okay. Your vada is not for sale, but it is kept in it cannot be sold, but it is not your raw materials. What is your raw material in vada pav business? It is your aloo, and your pav is your raw material, but your vada, the one which you have prepared using batter and aloo, that is your production in process. That is your work in progress. Okay. So inventories are assets, which is your finished goods, WIP. Okay. Your vada is your WIP. Next we have materials and supplies used in production for process. Okay. That is your raw material. That is your vada. Sorry. That is your batter. Okay. Your besan batter, your aloo, and your pav. Okay. So that is your raw material. Okay. So what we are trying to do in this chapter is we are trying to value all these items on balance sheet date. What is your balance sheet date? It is the end of the year. What is the end of the year? It is 31st March. Okay. On 31st March, I have to value my inventory. Okay. So why are we valuing inventory? Okay. So why are we valuing inventory? Because inventories are not a result of transaction. Okay. It is not a result of transaction. It is valued. Okay. Inventories are valued and it is not transacted. Okay. So you don't pass any journal entries for inventories. Okay. We are just valuing it. Okay. On 31st March, you just value it. In your articleship experience, you would have seen that inventories are never transacted. It is just they just put a figure in the balance sheet. Okay. So that valuation we are going to learn. Okay. So how do we value inventory? So how valuation or measurement of inventories, how it is done? Finished goods or WIP. Okay. Finished goods or work in progress. How do we do it? We do it by lower of cost or net realizable value. Means what? Your finished products. Okay. We are following the concept of prudence here. Okay. Means what? We are not overestimating. Let's suppose you are giving an exam. Okay. Now, you know you wrote for 60 marks. But do you account for that you will get 60 marks? No. You take a side of caution and you say that plus or minus 10 marks will be there. Okay. So actual marks you are expecting is 50. Okay, you wrote for 60 but you are expecting 50. So means what? You are applying prudence there. So here in inventories also what is happening here is that you are going to use that principle only. Means what? Lower of cost or NRV. So what do you mean by cost? Cost is the purchase price of the inventory. Okay, let's suppose you purchase the pav for 2 rupees. So that is your cost. Okay, what is net realizable value? Net realizable value, we are going to see a separate topic on this, but here I'll explain it in ease. Okay, explain it in simple words. It means what? If you are trying to sell the pav in the market in the current date, how much will you get it? Okay, you bought it for 2, but when you are going to sell it, you are getting only 1 rupee 50 paise. So you will you will value the inventory at 1.5 only. Okay, so whichever is lower will value at that. But if you have bought it for 2 rupees and in market it is selling for 2.5 rupees, you will value at 2 only. Okay, we will take whatever is lower. Okay, you have already learned this in your AS also. Here this point is repeated. Okay, next is your raw material. So how do we value raw material? Okay, so this one is your finished goods or WIP. Okay, but finished goods or WIP you will value at lower at cost or NRV. Okay, whichever is lower. For raw material, how do we value raw material? Okay, so the raw materials value depends on your finished goods. Okay, if your finished goods is expected to be sold more than cost, okay, it is expected to be sold more than cost, then you will record the raw material at cost. Okay, at cost. Now your finished goods is expected to be sold lower than cost, means what? You are going to be at loss, so you will not proceed to make the raw material into finished goods. Okay, so you will replace that item, you will replace that raw material for another item. Okay, so means what? You are going to sell it in the market. So which amount will you sell it for? It is measured at lower of cost or NRV or your replacement cost. Okay, so at replacement cost we'll do it, we'll value it. So here cost will be generally higher than your replacement cost. Okay, so this is a measurement of inventory. Okay, this is the basic principle. Okay, next we have is some other things. Okay, so this is the basic principle which we'll follow in this chapter. So there are some notes regarding this. What it is we'll see. The first one is your inventory. Inventory can be measured. Okay, inventory are measured in two types, in two ways. That is your item by item basis or your group basis. So what is item by item basis? It is that, let's suppose you have a fast food center. Okay, you have pani puri, you have vada pav, you have frankie, etc. Okay, so now one method is item by item. Means what? I'll value my aloo differently. Okay, I'll value my vada pav differently, my pani puri differently, and my frankie differently. Okay, this is item by item. Okay, next is group basis. Sorry, item by item means what? You value aloo differently, batter differently, besan differently, and oil differently. This is item by item. And what is group basis? It is vada pav, pani puri, and your frankie. So this is group basis. Okay, so however it is done in question, we'll see. Okay, so for example, we have shirts here. Okay, the cost is shirts 1 to 3. Okay, the shirt number is 1 to 3. Okay, means what? This is different items of shirts. We are numbering it 1 to 3. Okay, we have given separate name for it. Okay, 1 to 3. This is name of the product, and there is cost and there is NRV. Okay, so how do you value it? Lower of cost or NRV. So NRV is lower here, we'll take NRV. So here cost is low, so we'll take cost. And for third, we have cost is low and we'll take cost is low. Okay, so valuation, how much is the valuation? We'll take individually and we'll total it and we'll put it in the valuation. Now what is valuation by group? We'll take total. Okay, shirts, cost, shirt item is there, we'll take cost and NRV. We'll take total of it. So cost is 1000 and NRV is 1100. We'll value it lower. Okay, so 1000 is the valuation. Okay, this principle is applied in IND AS. Okay, IND AS gives us two valuation methods. The first one is your item by item and the second one is your group basis. Okay. Now, the inventories are valued at balance sheet date, at each balance sheet date. I told you earlier that inventories are valued at the balance sheet date, that is on 31st March of every year. Okay, whenever an accounting year ends, we value inventory. Okay, we measure inventory. Okay. In silent situation, okay, in silent situation, when in question it is not given, then we'll take item by item basis. This is preferred and not group basis. Okay, so I have explained it to you very well from Ajay Agarwal's book, the meaning of inventory and measurement of inventory. Now we'll move on to the next topic, which is cost of inventories. Okay, we'll spend this whole lecture for AS2 inventories only. Okay, it is relatively a small chapter, so we will try to finish it in one go. Okay. So the cost of inventory. So what is cost of inventory? If inventory is purchased or produced, okay, we have two things here. Okay, inventory is purchased or produced. Okay, we'll value it differently. Okay, it includes any cost necessary to bring the inventory to present location and condition. What all to be included in the cost of inventory? Okay, it includes any cost necessary to bring the inventory to the present condition and location. Okay, that is some things are included. Okay, so what it is we'll see. For calculation of cost of closing stock, we have to calculate cost of total purchase of production during the period. Firstly, as follows. Okay, now what is this logic? What we are trying to do here is, when we measure any inventory, okay, when we measure any inventory, what we do is that we'll try to take cost of production first. So what should be the value of your inventory? Okay, your value of inventory should be at cost or NRV, right? So what should be included in the cost? Okay, your inventory should not be in sale value. Okay, it should be in cost only. Okay, so what forms part of cost? Okay, so your inventory, your raw material or your finished goods, let's suppose. Okay, it is not separate from the production process. Okay, what is your inventory? It is whatever left over from your production process. Okay, so what we do is that we'll take whole of your production. Okay, we take whole of your production and then we'll divide it by the number of units. Okay, total number of units, and we'll multiply it with the number of items left. Okay, so that we'll get the individual units cost. Okay, individual units cost. That means how much, let's suppose 1000 units we have produced and 200 is left over. So what is the value of 200 cost? It is the total divided by 1000 into 200, right? So what is, we have two methods here. Okay, the first one is your, in case the goods are purchased, okay, we'll see purchased and then it is produced. Okay, this is used for WIP and this is for finished goods and this is for WIP. Whatever it is, we'll assess as per the question. Okay, if the goods are purchased, okay, if the goods are purchased, then what is it? In question they would have given what are the goods purchased, so how do we value it? Okay, the first one we include is purchase price. Okay, what is included in the cost? It is the purchase price. It is a basic cost which we include. Okay, the next one is your trade discount and rebate. Now what do you mean by trade discount? Let's suppose you purchase 1000 units of goods. Okay, so since you are purchasing in bulk, your supplier will give you some discount, right? You'll ask some discount for him because he's getting to sell more items, so that's why you'll ask some discount. So this discount is known as trade discount. He'll give you 5% discount, right? So this discount is known as trade discount. So what will happen here is that this we will deduct it from purchase price. When he makes an invoice, there you'll discount that amount. Okay, that is not included in your cost of inventory. We'll deduct that amount. Okay, next we add is import duty and taxes. Okay, GST amount is added in your invoice, right? So that amount will add. Okay, but if your GST in while you add those GST, if you are getting input tax credit ITC, means what you'll get at, you will be refunded that tax, then we will not include that in cost. Okay, if it is non-refundable, then we will add it. Okay, then we'll add transport or freight charges, means whatever the delivery charges you are paying for that item to be delivered to your place, we will add it. Okay, next is other handling cost, any hamali charges, okay, any coolie charges you give, okay, that will add. Next is insurance on purchase. Okay, while you are transiting in freight, okay, while you are transiting from freight, you incur some insurance cost. Okay, so that is also added here. And a brokerage to indenting agents, means what you are buying commission. Okay, any commission you are paying for brokers, okay, to buy that item, it is also included. Okay, so that total becomes my cost of purchase, right? In case of produced goods, how do we calculate? Okay, so there what information is available? Direct material cost, direct labor cost. Okay, so what all to include it? The first one is your, so what do we include in produced goods? Okay, so the first one is your manufacturing account. Whatever comes in your manufacturing account will add. Okay, that is the primary cost that is involved to make a product is your produced goods. Okay, whatever is included in your manufacturing cost will add. The first one is your direct material cost. It is your direct expense, right? So what all direct expense is there, we'll add it. Okay, direct material cost, direct labor cost, production or manufacturing overheads. Okay, production or manufacturing overheads, it is divided into two parts, that is a variable and fixed. Okay, that is what comes in your variable cost. It is your designing cost. Okay, means what specific details your customer would have given. Okay, that is your variable cost. Okay, so what is your fixed overheads? Fixed overheads means that cost that is incurred in the factory for producing the goods. Overheads means your indirect expense only. Okay, whatever incurred in the factory is included in the cost of goods. Okay, so it means your depreciation on factory building and plant, factory rent, energy cost, etc. Okay, so that becomes your cost of production. Okay, now what we have to do is that we have to take cost per unit. Why we are taking cost per unit? Because in the end of the year we have some units left, right? Let's suppose we have produced 1000 units but 200 is left. Okay, for that finding the 200's value we need per unit cost, right? So for that we are doing per unit cost. So cost per unit is cost of production or purchases. Okay, both are the same only. Okay, purchases we have different process and production we have different process. Okay, cost of purchases or production divided by actual units produced or purchased. Okay, we'll get cost per unit. Now what we'll do is that now this cost of purchase or production will be bifurcated as follows. Okay, so as I told you that 1000 units we produced, 200 is left. So 200 into cost per unit will get closing stock value, right? So units of closing stock into cost per unit will get closing value inventory. Okay, so can you see what we are doing here is that first we tried to see that what is the inventory valued at. It is valued at cost or NRV. Okay, so now we are learning the cost part. Okay, so the cost part we are finding now. Okay, so next, what is the cost of others? Okay, now we have cost of goods closing stock we found out, that is units in closing stock into cost per unit. Now what is the other thing? That is cost produced. Okay, so what do we call it is that cost of goods sold. Okay, or in question they would have given cost of sales also. Okay, it also means that cost of goods sold only. Okay, so out of this purchase or production. Okay, means what is that this unit means what? Cost of goods sold means what? The amount which is sold. Okay, the amount of goods, the number of goods which is sold, what is the cost of it? Okay, the produced thing is different. Okay, the one which is sold, what is the cost of it? Okay, so how do we calculate it? It is that cost of purchases of production. Okay, the total production minus your closing stock. Okay, 1000 units you produced minus 200 is your closing stock. So how much did you actually sell? That is 800 units. This is one step. Okay, on the next step or the next method is units sold into cost per unit. Means what? The number of units sold is 800 into your cost per unit. This way you can find out. Okay, so what is total cost or goods, cost of goods sold or thing? Okay, so what is the total cost of goods sold or cost of sales? So how do we calculate it? Okay, the one thing is this. Okay, the another method is this. Okay, so how do we calculate? Now imagine your trading account. Okay, so what is your trading account? What all items comes here? Okay, I'll make it here. Okay, here comes your sales and your closing stock, right? Here comes your purchase and your other purchase and other material, means what? Your production cost, right? So the differential figure is your profit, right? So what we are finding here is cost of goods sold, means what? Your opening stock plus your purchases or production. Okay, minus your closing stock. Total of this minus your closing stock, you will get cost of goods sold. We are excluding the profit part, right? So this is your cost of goods sold. Okay, there are some notes here which you have to keep it in mind. The first one is, in silent situation, assume all taxes are non-refundable. Okay, whatever tax you pay, import tax and GST, we'll take it as non-refundable. Next we have is, the following items are not included in cost of production or purchases. That is, we will never include these in this part. Okay, these following items are not included in the cost of inventory. The first one is your abnormal loss. So what is abnormal loss? Why is abnormal loss not a part of your actual production? Now, first of all, why we are trying to do accounts is that to have consistency. Okay, if one person is able to produce certain amount and due to our negligence we are producing less units or we are wasting more, then the users of financial statement will not get a clear picture. Okay, so that's why whatever due to negligence one person is committing, that cost will not be included. Okay, if I take an example in our CA fraternity, okay, so with proper coaching and proper study, one can pass an exam in, let's suppose, 8 months. Okay, but another person, he wastes his time to scroll reels, okay, to watch TV. Okay, that person has wasted his time. That is his abnormal loss. What is normal loss? Normal loss is that you are exhausted from studying and you take a walk. Okay, this is normal loss. Every student do, and it is necessary, okay, for producing a good. But the another case is your abnormal loss. Okay, that is watching TV, scroll. It is your own expense. Okay, it should not be included in the value of inventory. Okay. The next thing is your storage cost. Okay. Storage cost should not be included unless necessary for production. This part is important, but what do you mean by storage cost? Okay. Storage cost should not form part of your inventory. Okay. If you are producing a ice cream, let's suppose, okay, there storage cost is very much important. Okay, you have to incur refrigeration cost. But let's suppose you are producing bottles. Okay, their storage cost is not required. Okay, you have to make a good and then you have to sell it. If you are not being able to sell it, then it is your fault. Okay, so there we will not include storage cost. Okay, next we have is administrative overhead. Means what? The salary of accounting department. Means what? Whatever work we do as chartered accountants, whatever work we do, it is an indirect expense. It is not directly included in the production cost, so that is not included in the value of inventory. Okay, it is administrative expense. Okay, next one is the selling overheads or cost, that is sales commission, warranty cost. It is not necessary for your inventory, so we will not include that also. Next we have is cash discount. So what do you mean by cash discount? Cash discount means, let's suppose you are purchasing a product, okay, purchasing from a supplier. There the industry norms say that you have to give credit for 10 days. Okay, you have to give credit for 10 days. Okay, that is an industry norm that you have to follow to sustain in the industry. Now what you are saying is that to a supplier is that 10 days is the normal time, but if you pay today, I'll give you another discount of 1%. Okay, so this is in the nature of finance. Okay, so that's why this is not included in the cost, right? So finance cost is not included, so that's why we will debit it to P&L account only. Next we have is interest cost. Let's suppose for purchasing a product you are incurring interest cost. Okay, so that cost, interest cost, means what? Your finance cost. You are taking loan from the bank, it is not part of the inventory, right? So that interest cost should be debited to P&L only and not included in the value of inventory. Okay, so this point, this interest cost is an addition to your accounting standard. Rest all is almost similar. Next we have is allocation of fixed overhead. Okay, so what is fixed overhead? Fixed overhead is this part, your depreciation on factory building and plant, factory rent, etc. Okay, so what do we do is that fixed overhead allocated to cost of production during the period. Means what? Actual units produced into factory overhead recovery rate per unit. Okay, I'll tell you the formula first and then I'll explain. Okay, and the next we have is remaining fixed overheads that are expensed to P&L. Okay, means what? Unabsorbed financial fixed overhead, that is balancing figure, total fixed overheads minus your absorbed fixed overheads. Okay, what do you mean by fixed overheads? Fixed overheads is your this thing, depreciation of factory building, factory rent, energy cost, etc. Okay, so what does fixed overhead mean? Okay, why is fixed overhead incurred? Fixed overhead is the, let's suppose I have a warehouse, okay, but I'm using only the corner part of it. Okay, right now I'm using only the corner part of it, but when I'm paying the rent, I'll pay for the entire warehouse. Okay, not for the corner part only. But is this right? No, because another person what he's doing is that he has a total warehouse, but he's utilizing the whole capacity. But I'm having the total same amount of space, but I'm using only small part. Okay, same factory space, but I'm using only less part, but he's using total part. His value of inventory will be less, but my inventory will be more. Okay, so our IND AS says is that, what our IND AS says is that you should only account for this part, and the rest part is your mistake, and it should be expensed in the P&L account. Okay, so that's what our IND AS says. It is that you have to show only this part for in your value of inventory. So that's what here we are saying. So how do we calculate this part? So it is total fixed overheads divided by hire of normal units or actual units produced. What is normal unit? The whole of the area. And what is my actual unit? It is this. Okay. So what we are taking is that hire of normal units or actual units. So what is hire here? This is. Normal units is this one. Normally the whole part should be used, but we are actually using this part. So higher value we should take. Okay. But let's suppose this person is having this much space, but what is happening here is that he utilizes this whole space, okay, to the maximum capacity, but he's filling more items in it. Okay, he's shoving extra item in it. Let's suppose we have a bus. Okay, the bus's capacity is only for 50 passengers, but in rush hours 100 passengers travel by it. Okay, means what? Extra 50% is added. Okay, so what we'll do in that case is that we'll take total actually what happened is that 100 passengers traveled. So we'll bifurcate the thing in all passengers. Okay, so what higher amount is that actual figure, right? 100 passengers. So that's what is happening here also. Total fixed overhead divided by higher of normal units or actual units produced, right? So we'll get a recovery rate. Okay, into what we do is that actual units produced. Okay, the remaining figure is transferred to your P&L account. Okay, while doing question you will understand it better. If you didn't understand it now, it's okay. Okay, the next thing what is it is that if actual units produced during the period are not given in question, then it can be calculated as follows. Okay, if in question actual units produced is not given, then we'll calculate it as follows. That is, units of closing stock of finished goods, units sold of finished goods minus opening stock of finished goods. Means what we are doing is that we are calculating credit part minus the opening inventory. Then we'll get produced units, right? Simple maths. There is an example given here for your understanding. You can read it. I'll move forward. Next we have is profit earned on sale of inventory during the period. That is your gross profit. How do we take sales value minus a COGS? Right. That is, what is your sales value? Sales value includes your profit also, right? So sales value is including profit minus your cost of goods sold. What is your cost of goods sold? Cost of goods sold is cost of production into cost per unit, right? Or else opening plus total production plus your closing inventory. Sorry, minus your closing inventory. Then you will get cost of production, right? So that's what is given here. Okay, cost of goods sold, sales value minus total cost of goods sold. If inventory is acquired on deferred settlement terms, now this part is important for your whole FR, right? This, what it is, we'll see. If inventory is acquired on deferred settlement terms, that is payment beyond normal credit terms. Means what? Let's suppose you purchased an asset worth 1 lakh today, okay, and you're saying and you're telling the supplier that you will pay the amount after 1 year, okay. Then the supplier is saying that, okay, if you want to pay after 1 year, you will not get to pay 1 lakh, you will have to pay me 1,10,000, and you also agree, okay. Now, what is the cost of asset? Is it 1,10,000 or 1 lakh? Our IND AS says that it is, the cost will be 1 lakh only, but the extra 10,000 will be your finance cost. Okay, so that is what is written here. The extra amount paid over normal purchase price is recognized as interest expense over the credit period over the credit period in the P&L and not included in the inventory cost. Means what? The extra amount is credited, so the extra amount over the credit period is debited to P&L. Okay, the extra amount is debited to P&L account. Okay, if normal purchase is not given in question, then it is calculated by discounting the future payment. Means what? We don't know that 1 lakh is my amount. Okay, but what they are saying is that after 1 year you have to pay 1,10,000 and interest percentage is given in question. So how will we calculate it? It is 1 lakh divided by 1.1. Okay, sorry, 1,10,000 divided by 1.1. Okay, so we'll get the answer, right? So PV, I'm not teaching you how to do it. I hope you know how to do it, PV. Okay, we'll multiply it with the discounting factor. Whatever values in the future, we'll have to bring it to present. So we'll multiply it with discounting factor. So 1 divided by 1.1, I'm getting 0.909 into my 1 lakh. I'm getting it, sorry, 1,10,000. I'll get it as 1 lakh. Okay. Next, if more than one product are produced jointly, that is allocation of cost to joint product. Okay, so joint product costing you might have learned in your costing subject in CA intermediate. Okay, so that same principle is being applied here. Okay, so how will we calculate it? Firstly, we'll have to calculate joint cost, and then we'll allocate the joint cost to each of the products using sales value, right? So how do we arrive at joint cost? So joint cost we can arrive at first total common cost, okay, total production cost, total common cost, right, minus any sale of scrap, right? You would have generated any scrap from it, so here we'll have to less that, okay, less that income from that. Okay, another thing here is that NRV of byproduct. Okay, so what is a byproduct? You would have already learned in CA Inter, but I'm repeating it again. Let's suppose you have crude oil, right? You put crude oil in a machine, okay? While coming out, it comes as petrol, diesel, and then a byproduct you get, that is kerosene, right? So diesel and petrol is your main product, kerosene is your byproduct. Okay, so kerosene business they are not doing, so they will what? They will sell the kerosene at NRV in the market. So that byproduct is an extra thing that we are receiving from joint cost, joint production. So you will less it from the actual value. So minus NRV of byproduct minus amount realized from scrap. Okay, so we'll get joint cost and we will bifurcate in the ratio of sales, okay, of the main product, right? Next we have is cost measurement techniques or formulas. Okay, so how do we measure cost? Okay, what is a formula or formula? What is it? We'll see. First thing we have is interchangeable inventories and not interchangeable inventories. Okay, we have two things. Okay, one is interchangeable, another one is non-interchangeable. Means what? There is identical units and unidentical units. Okay, interchangeable. Let's suppose you want to buy a bread. Okay, so the bread which is produced today and the bread which is produced yesterday, both are same product only. You will use it interchangeably, right? You can buy anything, but in case of interchangeable inventories, it is specific to a consumer need, right? So it is not interchangeable. You cannot sell a dress that is custom made for a person to another person, right? So it is like that. Okay, so what is interchangeable inventories? We'll see. Okay, in that also we have two methods. Okay, the first one is historical cost methods and the second one is non-historical cost methods. Means what? You are keeping data if you are keeping stocks data, then we'll use historical cost method. And if you're not keeping any cost data, okay, then we'll follow, so in any inventory data, then we'll follow non-historical cost methods. Okay, what is historical cost method? We have two methods. The first one is your FIFO and the second one is your weighted average, right? So FIFA is what? FIFA is your first in first out. You would have already learned in BCom first year. Okay, I'm just repeating it here. Okay, so what does this method say is that whatever you produce first, you will take it out first. Okay, let's suppose we have a bread factory, right? So the products which you have produced earlier yesterday, you would try to sell it as fast as possible. Okay, so that is known as first in first out. Okay, the units purchased first are sold first. Units purchased or produced first are sold first. And what is weighted average? Weighted average means you take a total amount, okay, you take an average price of it and then you sell it. In FIFA, what happens is that yesterday, let's suppose you incurred 12 rupees to make bread, and today you are incurring 14 rupees. Okay, so when you are selling that 12 rupees bread, you will sell it for 12 rupees only because it is in first out method. But here in weighted average, what happens is that when you are purchasing any material, that is yesterday's bread and today's bread, you will take a common cost, okay, and then for rupees 13 you will sell it. Okay, so how do we calculate it? It is easy. Cost of opening stock plus cost of purchase or production divided by units in opening stock plus units purchased. You will get a figure. Next we have is non-historical cost methods, that is the retail method and standard cost method. Okay, standard cost method is what we have learned in standard costing. Okay, fixed standard cost per unit is used. Okay, this is not used as such. This retail method is used mostly, right? Retail cost method, it is also known as adjusted selling price method. Okay, so what do we do in this is that we have a retail price of closing stock. Okay, now what we are doing is that cost measurement techniques we are following. So retail price of closing stock is given minus what we do is that gross margin. What is the retail price? Retail price means the price which you are willing to sell the inventories. Okay, which you are willing to sell the inventories is known as retail price. Okay, retail price of closing stock means what? Selling price of closing stock. So here you are taking out the gross margin percentage, okay, minus gross margin. This is known as retail method. Okay, adjusted selling price method. Or how you can do it is that retail price of closing stock into cost of retail price. So let's take an example. Okay, the product is costing 100 rupees, okay, but you are selling it for 120. Now what is the profit here? 20. Okay, so what is your gross margin percentage? So how do you calculate gross margin percentage? 20 divided by 120, right? So it is 0.16%, 16.66%. So what you'll do is that, let's suppose your retail price of closing stock is 100. So minus 16.66 if you do, you'll get the answer as 100. Okay, so this is known as retail costing method, retail method. Okay, another thing what you can do is that cost price method. So what is happening is that minus 1 if I do, so this should be my cost, right? 16% is my profit, so 83% should be my cost, right? So 83% into 120 if I do, I'll get cost, okay, and remaining figure I'll get profit. Okay, so that way also we can do. Next we have is inventory is not interchangeable. Okay, means what? Specific identification method generally used in jewelry or tailor-made industries. Okay, jewelry items is you give an order in the jewelry shop and then they make your specific requirement, right? So this is not interchangeable. So here cost is calculated specifically. Okay, I'm not using this method. Entity shall use same cost formula for all inventories having same nature. Okay, let's suppose he has interchangeable inventories and historical cost methods. Yeah, he follows historical cost method for interchangeable inventories, and non-interchangeable inventories he doesn't have. He has both the products. Okay, now he cannot apply historical cost method in interchangeable inventories. Okay, he has to follow everything in the same thing only. Okay, and he cannot also do, like, for one product he will take interchangeable. Okay, specifically he is calculating, and for another he is taking FIFO method. Okay, that also he cannot do. Next we have is NRV. How do we calculate NRV? As I told you in the starting of the chapter that I'll explain NRV later, right? So what is NRV? NRV means the estimated selling price of the product, right? So let's suppose you are in the business of making butter and cheese. Okay, so what is your raw material? It is your milk, right? When you put milk in a machine, you will get what? Cheese and butter, right? Also there is a small thing that is being collected. Okay, a small liquid is collected. That liquid is your whey, right? WHEY, whey. Okay, now you also have now this whey is used as raw material for whey protein, right? So now what you have to do is that you have to package it and sell it to whey protein producing industries, right? So you cannot sell that total whey like that only in the container, right? So you have to package it first. Okay, so for that you have to incur specific cost, right? So okay, that is for joint product. Okay, so here NRV, what we are doing is that the same principle also applies here. We'll have estimated selling cost, that is the packaging, and estimated completion cost. Okay, let's suppose we have the same factory of BA also. Okay, and we are estimating some certain finishing cost. Okay, the machinery, the processing and packaging charges. Okay, so we'll get the amount. In simple, what it is that estimated selling price will deduct all the selling related expenses, so that we can get NRV, right? NRV is calculated on the basis of expected date for sale of such inventory. Okay, so it is, we have to calculate not today. Okay, on the expected date of sale, what is the value, you have to take it. So this was the total IND AS 2 inventories. I hope you have understood it. In the next lecture, we will try to solve some questions which are tricky. Okay, some questions which you wouldn't be able to solve just looking at the notes. That questions we will cover here. Okay, so what it is, we'll see that in next lecture. Till then, tata, bye bye.